Okay, good morning, class. Welcome back to our, is this our second session or third? I'm losing track already. Okay, so welcome to Chapter 23, Performance Evaluation for Decentralized Operations. In the last chapter, we discussed cost components, we discussed some manufacturing, we also discussed some budgeting, and then this chapter kind of pulls a little bit more together and goes a little bit deeper. So let's go ahead and get started. Okay, so we're going to talk about decentralized operations. We talked about centralized operations in the past. Now we're going to talk about decentralized operations. As you probably recall, centralized operations are where decisions for planning and operating decisions are made by top management. They're made by the CEO, the CFO, the COO, CIO, your VPs, your general managers, all the top brass, right? Those in a centralized operation, all decisions are made at the top. In a decentralized operations, decisions are made at the division or the unit level. This is where the department managers are the ones making decisions for the company. And in this type of operation, division managers can typically make better decisions than top management because they're closer to the customers, they're closer to the products, and they're closer to the way the company's structured. So in my personal opinion, I like decentralized operation companies because the managers are able to make more effective decisions for their respective departments or divisions. So here's some advantages of the decentralized operation. For larger companies, it's more challenging for top-level management to maintain daily contact with operations and to maintain expertise in all product lines and services. This is where decentralized operation is much better because the unit level managers or the department level managers are able to make better decisions because they're in close contact with their respective operations. So in such cases, delegating authority to the managers closest to the operations usually results in better decision making. So again, the department level managers are able to make better decisions than the top level management is in a decentralized operation because the department level managers are closer to the operation and they're able to make better decisions about their products, their customers, and their services. So decentralized operations provide excellent training for managers, as you would think, because if you're a department level manager and you've been given the authority to make decisions based on your products, your services, and your customers, that provides you with expert level training because you're given that authority, and as you're making those decisions, it better positions you as a manager to move up in the organization or to obtain a better position. And so therefore it's viewed as having very good training from that perspective. Delegating responsibility allows for managers to develop managerial experience early in their careers. Oftentimes we see that department level managers are viewed as lower level management, but because they're able to have that authority and that responsibility, it gives them that opportunity to develop into better managers and to move up earlier on in their careers. This also helps companies retain management because it provides them with the opportunity to be later promoted to top-level management positions. Managers in a decentralized operation oftentimes work very closely with the customers, as you might expect. As a result of this, they tend to identify with customers and thus are often more creative in suggesting operating and product improvements, of course, to help foster better customer relations. Some disadvantages of a decentralized operation include things like the operations that the decisions made by a manager could negatively impact the profits of the company. For example, if a unit level manager makes a purchasing decision of inventory that is at a higher cost and a lower profit margin, that could potentially have a negative impact on the profits for the whole company. Another disadvantage of decentralized operations is that assets and expenses may be duplicated across divisions. For example, we talked about Macy's as one of our examples. Let's say we have two department level managers. We have somebody managing the men's clothing and we have someone managing the women's clothing. These two different department managers may be making the same decisions with respect to their inventory and their expenses. In this process, those purchasing and expense decisions are being duplicated. For example, instead of cross-utilizing employees to work in both the men's and women's clothing lines, oftentimes what we see is the expense for the labor of those employees working in each respective department are being duplicated. What managers should be looking at is cross-utilizing employees across departments. So therefore, that's maybe seen as a disadvantage of decentralized operations. So looking at this a little bit closer, other advantages include allowing managers close to operations to make decisions, provide excellent training for managers, allows managers to become experts in their area of operation, helps retain managers, and improves creativity and customer relations. Disadvantages include things like decisions being made by managers could negatively affect profits of the company and duplicating assets and expenses. So it just kind of summarizes what we just talked about. Are there any questions so far? No? Is everyone good? Great. Wonderful. Okay. Wonderful. Okay. So in a decentralized business, accounting assists in managers in evaluating and controlling their areas of responsibility. These are called responsibility centers, as we talked about in Chapter 22. Responsibility accounting is the process of measuring and reporting operations data by the responsibility center. So what happens here is that the accountants work very closely with the department managers, and they help the department managers to read the financial reports to better understand the decisions that they're making. Now, as you know, cost centers, which have the responsibility over costs, profit centers, which are responsibility over revenues and costs, and investment centers have responsibility over revenues, costs, and other investment assets, like we talked about in the previous chapter. In this area, responsibility accounting encompasses all of these things. And it helps the department level manager to make better decisions based off of things like their asset purchasing, their profits or their revenues, and of course their costs and expenses. The cost center manager has a responsibility for controlling costs. However, the cost center manager does not make decisions concerned with sales or the amount of fixed assets invested in the center. Cost centers may vary in size from small department to an entire manufacturing plant. Cost centers may exist within other cost centers. So an example here would be in a department you have let's say it's the electronics department. In the electronics department, you have TVs, audio, you have gaming, you have other types of components, things like that. And so in that department, the TVs might be classified as its own cost center because they have their own costs associated with the TVs, which are different from the components, which are different from the audio, things like that. So that's why we say cost centers may exist within other cost centers. Does that make sense?
Mm-hmm.
Great. Wonderful. Let's keep rolling. Okay, so here's a graphic representation of an example. Within, let's say it's UDC, okay? Here at UDC, we have the College of Business, College of Engineering, College of Arts and Sciences, and of course, there's a few others. Within the College of Business, that's where we are, right? Within the College of Business, we have the Department of Marketing, Department of Accounting, and Department of Management. And as you might imagine, the Department of Accounting is where this course exists. This kind of just shows you how a cost center like the Department of Accounting exists within the cost center of the college and exists within the cost center of the university.
Mm-hmm.
Responsibility accounting for cost centers focus on controlling and reporting of costs. Budget performance reports that report budgeting and actual costs are normally prepared for each cost center. So just like we talked about in the previous chapter, each department has its own budget. And so because each department has its own budget, of course, they have their own cost centers. And so what we do is we compare the budget to the actual cost, just like we did in the previous chapter. And so in this concept, we're comparing the budget to each cost center. Here's an example of a representation of the responsibility accounting reports for the cost centers. At the top level of management, you have the vice president of production. They're responsible for both plants A and B. Within each plant, there's a plant manager. And manager of plant A manages the plant A. And then within each plant, there are departments. And then within each department, there are supervisors of that respective department. So if you, again, going back to our earlier example of Macy's, if you think of this as being Macy's, you have departments. You have your clothing department, your electronics department, your home goods department, so forth and so on. And so each department has a department supervisor. And those department supervisors report to the store manager. And the store manager reports to the corporate office, and so forth and so on. So it's very similar to the way it works in production as well, as you can see here. So as you would imagine, each plant has a budget for each department, and each department supervisor is responsible for that respective budget for each department. And we can see from this graphic representation how everything is accumulated. So, for example, in Plant A, we have the departments 1, 2, and 3. And there's a budget for each department. And then we can break it down further by department. And you can see like Department 1, which is highlighted down here on the third part of this representation. Department 1 has a budget of $109,725, which is accumulated by all of these respective items within that budget. And as you might imagine, over time, we compare the actual performance to the budget, and we look at how each line item is either over or under on the budget, just like we did in the previous chapter. The only true difference here is that we're looking at it from a department level rather than just a plant level. So here's an example. I like this example. It's nice. The nuclear power company's costs were over budget by $24,000. The company is divided into the North and South regions. The North region costs were under budget by $2,000. Determine the amount of the South region's costs that were over or under budget. So class, can you tell me how much was the South region of this company over or under budget? What do we think? Any guesses?
This to the North region was under $2,000,
That's correct.
and the nuclear was over by 24. So that leave them at 22, because that's the one cancel. Does the North cancel out?
Not quite.
Okay.
Not quite. You're on the right track, though. Okay, so let's break down the question, and then let's see what you think after we break it down. So the first sentence says nuclear power company costs were over budget by 24,000. Okay, the company has two regions, north and south. The north was under by 2,000. How much was the south? So, I'm sorry, what was that?
Yeah. So it is 22,000 for the south, because it was 24 in all.
Not quite.
Okay. All right, I'm shut up.
Not quite. Somebody said 18. Not quite. Devon said 18. That's not right. Okay, so again, let's go back to the first sentence. The company's costs were over budget by 24,000. The north was under budget by 2. So that would tell me, again, the whole company is over by 24,000. The north region was under by 2. You might think that 22,000 is correct. However, what this tells me is that the southern region absorbed that $2,000. And so therefore, the entire company, or the south region, was over by 26,000. So again, the whole company was over by 24,000. All right. The north region was under by 2. That means that the south region absorbed that $2,000, and they're really over by 26. Does that make sense? Questions on this? You got it? Okay, great. Again, if you have questions, you let me know. I'm here. All right. Don't worry, there will be some more examples. The responsibility accounting for profit centers. So let's talk more about profit centers. Profit centers managers have the responsibility and the authority to make decisions that impact both revenue and costs, and thus profits. As you might just, when you think about profit centers, think about your income statement. On your income statement, you have revenues and you have expenses. Of course, the difference we know is profit. So think about the profit center. When you see this, think about your income statement. So profit centers may be divisions, departments, or products. The manager does not make decisions concerned with the fixed assets invested in the center. That's the authority of someone else. So that's nice. They don't have to worry about that. The asset center takes care of that stuff. Yeah. So don't worry. We'll talk more about that here in the next few slides. So again, the profit center manager is really only concerned about the revenue and the expenses, and of course the profit. Responsibility accounting for the profit centers focus on reporting revenues and expenses, and thus income or net income, sometimes not loss, but mostly net income, from the operations. Again, think about your income statement. Revenue minus expenses equals net income. Same concept applies to your for the responsibility accounting for the profit center. We're really looking at the income statement. So thus, responsibility accounting is reporting for the profit centers take the form of an income statement. The profit center income statement should include only the revenue and expenses that are controlled by that respective manager. The controllable revenues, again, that word controllable, we talked about that in the previous chapter. Controllable revenues are revenues that are earned by the profit center. Again, when you hear the word controllable, it means it's within the control of that respective manager. That respective manager can control the revenues. They can control the expenses. So controllable expenses are costs that can be influenced or controlled by the decisions of the profit center managers, just like we talked about in the previous chapter. Let's talk about service department charges. So we talked about the respective centers. Now let's talk about service department charges. So the controllable expenses of profit centers include department operating expenses such as sales salaries and utility expenses. In addition, the profit center may incur expenses provided by internal centralized service departments. Basically, what this part tells us is that the department levels are indirectly responsible for the company's overall charges. Think about this as being your overhead, okay? And so the overhead, as you know from previous chapters, is a part that is indirectly attributed to the respective departments. And so examples of the service department charges would include things like R&D, or research and development, legal expenses, telecommunications, that includes your internet and your telephone, things like that, information and computer systems, like software, facilities management, those are your janitorial expenses, things like that, purchasing expenses, advertising expenses, payroll accounting expenses, that would be like the actual cost of the accounting department to issue payroll checks, transportation expenses, human resources expenses, so forth and so on. Now, all of these are centralized, meaning they're controlled by the overall company. These will be classified within your overhead, but they get attributed to each department based on the level of activity within each respective department. And don't worry, we'll show you some examples of how this works. Service department charges are indirect expenses to the profit center, just like we just discussed. They're similar to the expenses that would be incurred if the profit center purchased the services from an outside company. We call that outsourcing, right? A profit center manager has control over services department expenses if the manager is free to choose how much service is used. In such cases, the service department charges are allocated to the profit centers based on the usage or activity level of the service by each profit center. Okay, this is one of my favorite examples. Let's pretend they're Disney. And the reason why let's say pretend they're Disney, because they have theme parks and movie divisions. So they're really Disney, okay? Disney. Okay, so Disney is a diversified entertainment company. They have the following two operating divisions organized by profit centers. We have the theme park division and we have the movie production division. Okay, this is probably daily if it's Disney, honestly, but just throwing that out there. The revenues and direct operating expenses for the two divisions are as follows. The revenues for the theme parks are $6 million. The revenues for the movie production division are $2.5 million. The operating expenses for the theme park are $2.495 million. And the movie production division operating expenses are $405,000. The operating expenses consist of direct expenses such as the wages and salaries of division employees. Everyone's good so far? Mm-hmm. Great. So Disney's service department and expenses incurred for the year are as the following. Our purchasing expenses were $400,000. our payroll accounting expenses were $255,000, and our legal expenses were $250,000, giving our total of $905,000 in service department expenses. Now, here's how we break it out, because the company needs to allocate purchase expenses, payroll accounting expenses, and legal expenses to the respective departments. We do that based off of what we call activity-based costs, okay? So this is a very important concept to understand. So essentially what this tells us is that we allocate the expenses for purchasing, payroll, accounting, and legal to the respective divisions based off of their activity bases. An activity base for each service department is used to charge the service department expenses to the two divisions, the theme park and the movie production divisions within Disney. The activity base for each service department is a measure of the services performed. So for purchasing, it's based off of the number of the purchase requisitions for each division. For payroll accounting, it's based off of the number of payroll checks that were issued for each division. And for legal, it's the amount of legal hours billed for each division. So here's how it looks in our example for the theme park and movie production divisions. For the theme park, we had 25,000 purchase requisitions. We issued 12,000 payroll checks to our employees in the theme park, and we were billed 100 hours from our attorney for the theme park. In the movie production division, we purchased 15,000. We had 15,000 purchase requisitions. We issued 3,000 payroll checks to our employees, and we were billed 900 hours from our attorney for the movie production division. And of course, we total all of those up. So in total, for the whole company, we had 40,000 purchase requisitions. We issued 15,000 payroll checks for the whole company, and we had a total of 1,000 legal hours that were billed to us for the whole company. Sounds a little low for Disney, just in my opinion, but okay, so let's keep going. Now, what we need to do to understand how much each, we have to understand what we call the service department charge rate. This is basically how much each unit of those rates are, okay? So let's break it down. The rates of which services are charged to each division are called department charge rates. We compute this by taking the service department expense, we divide that by the total service department usage. So for Disney, the service department charges are computed as following. For purchasing, we had $400,000 of purchases, and the company had a total of 40,000 purchase requisitions. So we take the total amount of purchases, divide that by the total purchase requisitions to get $10 per purchase requisition. We got that by taking our 400,000 divided by the 40,000 purchase requisitions to get us a total of $10 per purchase requisition. On to payroll. For payroll, we issued $255,000 worth of payroll. The number of checks issued were 15,000. That gives us $17 per payroll check. Now, clearly, we did not pay all of our employees only $255,000, right? This is how much that we were billed to issue the checks, okay? So think of, in your company, you probably utilize someone like EDP or or Paychecks or one of the other payroll processing companies. Now, the way it works in real life, in business, is that we take the hours that you worked, if you're hourly, or your salary. We take that, and we tell the payroll processing company how much you need to be paid. And so we take all of our employees and we send that data off to the payroll processing company, like ADP or Paychecks. And what they do is they process the payroll checks and they mail them to you, or they provide you with direct deposit. And so, of course, that costs us, the company, money. It's not free to us. And so, based off this calculation, ADP or Paychecks billed us $255,000 for that year. The company issued 15,000 payroll checks, so that gives us $17 per payroll check that in cost that it took us to issue per check. Make sense? Yeah, great. And so the same concept applies with legal. The company was billed $250,000 for legal at 1,000 hours, so that's $250 per hour for legal. Honestly, that's a pretty low rate for an attorney, just saying. Okay, so let's apply that. So the services used by each division are multiplied by the service department charge rates to determine the service charge rates for each division. We do that by taking the service usage times the service department charge rate. Now let's apply that to our example. A question so far? Sounds good? Right. So let's apply that to our example. For purchasing, the theme park division had $250,000 in purchases, and the movie division had $150,000 in purchases. How did we get there? We took the number of requisitions for each division. In the theme park, they had 25,000 purchase requisitions for the year. And we know that based off of our earlier calculation, we had $10 per purchase requisition. That's the cost of each purchase requisition times the 25,000 purchase requisitions gives us $250,000 for the theme park for purchasing. For the movie division, they had 15,000 purchase requisitions at $10 per purchase requisition in cost to get us to the $150,000 in total purchasing cost for the movie division. For payroll, the theme parks issued 12,000 checks in payroll at $17 per check. That's $204,000 in payroll cost to the theme park division. For the movie division, they issued 3,000 checks at $17 per check. That's $51,000 for the movie division. For legal, the theme park was billed 100 hours at $250 per hour. That's $25,000 in legal expense for the theme park. And the movie division was billed 900 hours at $250 per hour. That's $225,000 of legal expense for the movie division. Everyone with me so far? Does this make perfect sense, hopefully? Mm-hmm. Great. Sip of coffee. Let's roll. Okay. So that was our theme park example. Now let's use another example. Of course, I'm going to ask the class for your input on this one. Okay, so the legal department for, let's say, Johnson & Johnson has expenses of $600,000. The department has provided a total of 2,000 hours of service for this period. The East Division has used 500 hours of legal service, and the West Division used 1,500 hours of legal service. How much should each division be charged for legal services? What do we think? Well, let's start with the East Division. How much of legal expense should be billed to the East Division? What do you think? Break out your calculators on your phones or whatever. Let's think about it. You got $600,000 of total legal expense. Okay. So the first thing you do is you take your 600,000 hours, $600,000, and you divide that by your 2,000 hours to get your hourly rate. Right? And then you take your hourly rate and you multiply that by the hours for each division. So who can tell me? The East Division at 500 hours, what were the legal expenses? Remember, you're muted. If you want to answer the question, unmute yourself. 150,000?
150,000.
That's a good guess. That sounds about right. Let's see. That's correct. 150,000 for the East Division. We got there by taking your 600,000, divide that by 2,000 to get your legal per hour. We multiply the legal per hour times the 500 hours used to get 150,000. That's correct. Now, what do we have for the West? 450,000. That sounds correct. Let's see. That is correct. We got there by taking the, again, 600,000 total legal expense divided by the total 2,000 hours to get our amount per hour. Multiply that by the total amount, the total hours used for that respective division to get 450,000 for the West. Wonderful. Very good. Okay. Sounds like you guys are getting this stuff. This is wonderful. All right, so let's keep rolling. So going back to the theme park and going back to Disney, theme park and movies. So let's look at our income statement. So for the theme park, we got $6 million in revenues. We have $2.495 in operating expense. You take your revenue minus your operating expenses to get your income from operations before service department charges. We know that the based off of the exercise we did earlier, purchasing had a total of $250,000 for purchase requisition expenses. Payroll expenses were $204,000. Our legal expenses were $25,000. We add up our purchasing plus our payroll plus our legal to get a total service department charges of $479,000. Now from here, what we do is we take our income from operations before the service department charges, subtract out our total service department charges to get our income from operations. Now, I want you to take note of this slide because you will see a very similar exercise on the homework for this chapter. Are we good? Does it make sense?
Mm-hmm.
Great. Okay, now on to the profit center. In evaluating the profit center manager, the income from operation should be compared over time to the budget. Just like we learned in the previous chapter, we're always comparing our actual to our budget. And we need to do the same for the income from operations over time to evaluate the performance of that respective center. However, it should not be compared across different profit centers because, as we would imagine, profit centers are usually different in terms of size, products, and customers. For example, we would not evaluate the profit center manager's performance for the theme park, and we would not compare that to the performance of the movie department. And the reason being is because those two centers are very different from each other. They have different sizes, they have different products, and they have different customers. So therefore, we would not compare the two to each other. However, we would compare their respective performance over time. For example, going back to Johnson & Johnson, we determined the divisional income from operations for the East and West divisions. The internal service charge for the legal department, as we know, was $150,000 for the East division and $450,000 for the West. The East division had sales of $300,000. The cost of goods sold was $1.650 million, and the sales expense were $850,000. Who can tell me what was the income from operations for the East Division? What do you think? For the East Division, what was the income from operations? What do you think? You guys know this. What were the income from operations? $350 for the East Division. Let's see. That's correct. And we got there by taking our sales minus our cost of goods sold to get our gross profit, minus our selling expenses to get our income from operations before service department charges. It said that we had legal department service charges of $150,000. So we took our income from operations before service department charges. We subtracted out our service department charges, $150,000 for legal, to get our income from operations of $350,000 for the East. That's correct. You would follow the same process to figure it out for the West. Very good. Okay, let's keep moving. Now let's talk about the investment centers. We talked about our profit centers. We talked about our cost centers. Now let's talk about our investment centers. An investment center manager is responsible for the authority to make decisions that affect not only costs and revenues, but also the assets invested in the center. So this person is responsible for making purchasing decisions for their assets, meaning inventory. So this person is responsible for inventory, revenue, and expenses. And of course, profit as well. The investment centers are often used in diversified companies by divisions. In such cases, the divisional manager has the authority similar to that of a chief operating officer or president of a company. So they're a little bit higher than a department manager, if you will. Because the investment center managers have responsibility for revenues and expenses, income from operations is a part of the investment center reporting. In addition, because the manager has responsibility for the assets invested in the center, the following two additional measures are used. we look at what we call rate of return on our investment and residual income. Rate of return on investment, you may know this as being what we call ROI. ROI are the letters that stand for the rate of return on an investment. Residual income. Don't worry, we'll have some examples of the two. We're going to use this new company, new example, new company. This is Datalink. Datalink provides internet services to various areas in the United States. Okay, so this company, Datalink, here's their income statement for their company. The company is broken out into the Northern Division, the Central Division, and the Southern Division. Each division has their respective revenues, their operating expenses, their income from operations before service department charges, and of course they have service department charges like legal and so forth and so on. And then they have their income from operations. So let's talk about ROI, or the return on the investment. This is a long part, so if you want to get some coffee, get some water, get some snacks or whatever. This is a long one. But don't worry, I'm going to continue, and as you might expect, this video is being recorded. So just a reminder, if you wouldn't mind muting your microphones while you're not speaking, that would be wonderful. Okay. So as you might expect, the investment center managers control the amount of assets invested in their centers. They should be evaluated on the use of these assets. So in this respect, if I were to purchase inventory as a investment center manager, I should be measured based off of how quickly I sell my inventory, right? How quickly I can turn my inventory. Talking about an earlier example that we had from the last chapter, we talked about blue jean manufacturing, remember? And then in that example, we talked about how our people that were using the sewing machines were cranking out the amount of blue jeans that were for sale during certain periods of time. And if I were an investment center manager, I would utilize my sewing machines to the best of their abilities. Because as you know, the sewing machines are an asset. They're equipment, right? And so in that example, as an investment center manager, I would be responsible for utilizing those sewing machines to crank out inventory for sale. That's utilizing the assets. So one measure that considers the amount of the assets invested in an investment center is what we call the rate of return on investment, or ROI. The rate of return, which is also known as the rate of return on assets. To calculate ROI, we take our income from operations and we divide that by our total invested assets. Don't worry, I'll show you some examples. The rate of return on an investment is useful because of three factors subject to control by the divisional manager. Revenues, expenses, and invested assets are considered. As we talked about earlier, investment center managers are responsible for controlling revenues, expenses, and invested assets. The higher the rate of return on an investment, the better the division is using its assets to generate an income. Of course, the opposite is also true. If the rate of return on investment is lower, then of course they're not utilizing their assets well enough to generate an income. In effect, the rate of return on investment measures the income, which is the return on each dollar invested. So if you think about it from our earlier examples, like using blue jeans, for example, if each pair of blue jeans cost me $10 and I sell it for $20, that means my ROI is $10 for each pair of blue jeans that I sell. My return is $10 for each pair of blue jeans I sell. As a result, the rate of return on the investment can be used as a common basis for comparing divisions to each other. And don't worry, I'll show you an example. So looking at our example, data link, the invested assets of data link's 3 divisions are the following. The Northern Division has $350,000 in invested assets. Central Division has $700,000, and the Southern Division has $500,000. Now, using the income from operations for each division from the earlier slide, the rate of return on the investment for each division is computed by the following. For the Northern Division, we take the income from operations divided by the invested assets. For the Northern Division, the income from operations was $70,000. Our invested assets were $350,000. This gives us a rate of return, or ROI, of 20%, which is pretty good. Because remember, as we talked about earlier, the higher the ROI, the better that division is utilizing their assets to generate revenue. In the Central Division, their income from operations was $84,000. Their invested assets was $700,000, giving them an ROI of 12%, which is okay. It's not great. The Southern Division had an income from operations of $75,000. Total invested assets were $500,000 for the Southern Division, giving us an ROI of 15%. And just as a side note, your ROI, or your rate of return on investment, will always be calculated as a percentage. Everyone's good so far? This example will come back. Yes? Great. Okay, now let's talk about a fun formula. Yes, I know you all love formulas so much. And you're like, Dr. B, I love formulas so much, I wish you would give us more. I know, that's exactly what you're thinking. Of course, I'll give you more formulas. Okay, so here's a formula that has been around for a very long time, since the 1920s, so about 100 years. So this, we're going to talk about the Dupont Formula. To analyze the differences in the ROIs across divisions, we utilize what we call the Dupont Formula for the rate of return on investment. The Dupont Formula looks at the rate of return on an investment for a product for using these 2 factors. Number 1, the profit margin, which, as you know, is the ratio of income from operations to sales. We talked about that several chapters ago. And, of course, our investment turnover, which is the ratio of sales to invested assets. Just as a side note, the Dupont Formula was developed by the Dupont Paint Company, or, well, back in the day it was called the Dupont Paint Company. Now they're called the Dupont Chemicals Company. This company was one of the very first companies to ever be publicly traded in the United States. back in the 1920s. So just as a little side note, this a little fun fact for you. Okay, so using the Dupont formula, the rate of return on the investment is expressed by taking your profit margin and multiplying that by your investment turnover. So let's break that down. So our profit margin, to get our profit margin, we take our income from operations and we divide that by sales to get our profit margin. To get our investment turnover, we take our sales divided by invested assets. Everyone's with me so far? And then to get our rate of return on investment, we multiply this by this. Okay. So one note here is order of operations. Please remember to do division before multiplication. So you'll do this division first, and then you'll do this division. And then after you've gotten your numbers from each division, you'll multiply the two together. So please remember order of operations, the PEMDAS. Okay. The Dupont formula is useful in evaluating divisions. This is because the profit margin and the investment turnover reflect the following underlying operating relationships of each division. The profit margin indicates operating profitability by computing the rate of profit earned on each sales dollar. Of course, if a division's profit margin increases and all other factors remain the same, the division's rate of return on investment will increase. Of course, the opposite is also true. Investment turnover indicates operating efficiency by computing the number of sales dollars generated by each sales dollar in invested assets. If a division's investment turnover increases and all other factors remain the same, the division's rate of return on investment will increase. Of course, the opposite is also true. Going back to our example. Now let's apply the Dupont formula to our example. Using the Dupont formula yields the same rate of return on investment for each of DataLink's divisions. As you know, ROI is computed by taking your income from operations divided by sales, and your sales divided by investment assets, and then you multiply the two together. In the Northern Division, our income from operations was $70,000 divided by the Northern Division sales of $560,000. We multiply that to the sales, $560,000, divided by the invested assets of $350,000 to get 20%. How we got 20%? 70,000 divided by in income from operations divided by 560,000 sales gets us 12.5%. And then we take our sales divided by invested assets. Sales 560,000 divided by invested assets 350,000 gets us to 1.6. We multiply 12.5% to 1.6. Gets us to 20% ROI. Everyone sees how we got that? Yes? Wonderful. Great. And of course, we would do the same thing for the Central and Southern divisions to calculate ROI. Based off of this analysis, we can see that the Northern Division's ROI is the best ROI out of the three divisions. Now, here in a little bit, we're going to apply this concept to decision making. To increase the ROI, the profit margin and investment turnover for a division may be analyzed. So let's look at the Northern Division. We assume that the revenues of the Northern Division could be increased by $56,000 through increasing operating expenses, such as advertising, to $385,000. One would assume that if I increase my advertising, that should result in additional sales, hopefully. And so the assumption here is if I increase my advertising to $385,000, that should yield me an additional $56,000 in expense. Okay, so the Northern Division's income from operations will increase from $70,000 to $77,000. Here's how it looks. Our revenues increased by $56,000 because, of course, we're doing more advertising, and that yields more sales, hopefully. So we take our original amount of revenue, $560,000, plus the additional revenue that we got from our additional sales, because we did some more advertising, $56,000. That gives me a total revenue of $616,000. Our operating expenses have increased to $385,000 because I'm advertising more, right? That gets me a new income from operations before service department charges of $231,000. I got $231,000 by taking my revenues of $616,000 minus operating expenses of $385,000 to get me a new income from operations before service department charges of $231,000. My service department charges for the division were $154,000. That gets me to an income from operations of $77,000. I got income from operations of $77,000 by taking income from operations before service department charges of $231,000, and I subtracted out my service department charges of $154,000 to get me to the income from operations of $77,000. Now I'll apply the ROI. The ROI, as you recall, are your income from operations divided by your sales. So income from operations, $77,000 divided by sales, $616,000, gets me to 12.5%. And then, of course, I take my sales, $616,000, divided by the $350,000, which is my original amount, gets me to 1.76. And I take my 12.5% times my 1.76, yields me 22% ROI. So based off of the assumption, if I were to increase my sales through increasing my advertising efforts, I could potentially increase my ROI by 2%. Because remember, originally the Northern Division had 20% ROI. So an additional ROI of 2% is wonderful. That means I'm utilizing my assets to generate additional revenue. It's wonderful. So it's a good decision if I increase my advertising to increase my overall ROI. So let's look at our ROI a little bit closer. ROI is also useful in deciding whether to invest additional assets or expand its operations. For example, Delegating should try to give priority to expanding its operations of its Northern Division because it earns the highest rate of return on investment at the existing 20%. In other words, An investment into the Northern Division will return 20% on each dollar invested. In the Central Division, each dollar invested would yield me 12%, or 12 cents on every dollar. And in the Southern Division, I would yield 15%, or 15 cents on every dollar. Make sense? Yes. Great. So essentially what this tells us is if the company is looking to grow or expand, they would want to make additional investment into the division that's doing well already in order to further utilize their assets to grow. A disadvantage of the ROI as a performance measure is that it may lead divisional managers to reject new investments that could be profitable for the company as a whole. So for example, Delegating, the Northern Division, currently has an ROI of 20%. Management set a minimum acceptable ROI of 10%. The minimum ROI is something that is set by top-level management to say that if the investment that we make into the company needs to be at this percentage or greater. The reason why management sets a minimum ROI is because management needs to cover their expenses in terms of financing. As you know, the expenses from financing include things like interest expense, right? So if the company takes out a loan from a bank for a new project, that loan typically has an interest rate that the company has to pay back along with the principal balance of the loan. And so the cost of financing needs to be the return on the investment needs to be greater than that interest rate for that loan. The same can be said if the company finances the project through issuing stocks and bonds. If the company issues stocks and bonds, of course, as you know, there's a discount rate or an interest rate associated with the issuance of stocks and bonds to investors. And so the minimum rate of return needs to be higher than the cost of the issuance of the debt or the equity. So if a manager of the Northern Division invests in a new project, the overall rate of return will decrease from 20% due to averaging. So in this example, we can see that the expected rate of return on a new project is 14%. The current rate of return on the investment is 20%. If the company decides to do this new project, the ROI will decrease because we take the 20% and average that with the new 14%. And as you know, to do averaging, you take the current rate of 20%, you add that to 14%, and divide by 2 to get your average. So thus, the division manager might decide not to do this project, although, of course, the project might help the company to expand. The reason why they might reject this project is because their current ROI would ultimately decrease for a short period of time, and thus would cause the manager to think that it may not be a good investment. Does that make sense to everyone? Yes. Still with me? hopefully. Great. Wonderful. Again, if you have questions, you are on mute, so please unmute yourself if you have questions. Okay, so that's ROI in a nutshell. It's a nice concept. So let's go through an example together. Campbell Soup Company has an income from operations of $35,000. The invested assets are $140,000. The sales of Campbell Soup was $437,500. We will use the Dupont Formula to compute the rate of return, ROI, the profit margin, the investment turnover, and the rate of return. Are you ready? So let's do the profit margin. What is the profit margin for Campbell Soup? What do you think? How do you calculate profit margin? Do you remember? Remember, you're on mute, so if you want to answer the question, unmute yourself. What do we think? 35,000 divided by sales. That sounds close. Maybe? Let's take a look. Yes. So if you take your 35,000 divided by your sales amount, 347,500, to get 8% exactly. Very well done. What about the investment turnover? What do you think? You guys know this stuff. Who can tell me what would be the investment turnover for this problem? 3.125? That is correct. We got investment turnover by taking our sales divided by our invested assets. You get 3.125. Now, last but not least, what is the rate of return on our investment? What do you think? What's our ROI here? 25%. That is correct. We took our 8% profit margin times our investment turnover of 3.125 to get 25%. Very well done, Devon. Very well done. Okay. Another 3 slides. Don't worry. I said 13. I got concerned there myself. Okay, so let's talk about another fun topic. I like this topic a lot because I like talking about revenue. I like talking about income. These are good stuff. Let's talk about what we call residual income. Residual income is useful in overcoming some of the disadvantages of the rate of return on investment. Residual income is the excess of income from operations over a minimum acceptable income from operations. The minimum acceptable income from operations is computed by multiplying the company's minimum rate of return times the invested assets. The minimum rate is set by top management based on such factors such as the cost of financing, just like I talked about a little earlier. If the company takes out a loan, we need to cover not only the loan, of course, but we need to cover the interest rate of that loan. If the company issues stocks and bonds to raise capital through equity, we need to be able to cover the discount rate or the interest rate of those stocks and bonds to cover the cost of financing. So let's look at it from this perspective. This is how the residual income report looks. We have our income from operations minus our acceptable income from operations as a percent of invested assets to get our residual income. So let's look at it from our company, Delegating. For the Northern Division, our income from operations is $70,000. Our minimum acceptable income from operations is $35,000. We got $35,000 by taking our income $350,000 times 10%. 10% is our minimum percentage that is acceptable, yes? 70,000 minus the 35,000 gives us residual income of 35,000. And you do the same thing for the Central and Southern divisions. You multiply their respective amounts, 700,000 times 10%, 70,000, 500,000 by 10%, 50,000, so forth and so on. The major advantage of residual income as a performance measure is that it considers both the minimum acceptable rate of return, invested assets, and the income from operations for each division. In doing so, residual income encourages division managers to maximize income from operations in excess of the minimum. This provides an incentive to accept any project that is expected to have a rate of return in excess of the minimum. In the world of finance, hopefully, if you go on to get your bachelor's degrees, you'll have a finance class. And in finance, we look at what we call net present value, which is the sum of present values from cash flow for a project that we anticipate. And we also look at what's called the IRR, or the internal rate of return. The internal rate of return is very similar to the minimum acceptable percentage for a project. And if the net present value of a projected project is greater than the internal rate of return, then we typically accept that project. And you'll learn a little bit more about that, I believe, in the last chapter of this course. And you'll also learn about that in your finance course when you go on for your bachelor's degrees. So don't worry, you don't have to worry too much about that in that course. I just wanted to give, for those of you who are interested in finance, a little bit of detail of how you'll be able to apply these concepts to finance. So let's assume that the following rates of return for the Northern Division. We have our current ROI of 20%, the minimum acceptable on any investment set by top management is 10%. And again, the 10% covers our expenses for financing. And the expected rate of return on the investment for a new project is 14%. If a manager of the Northern Division evaluates a project by only looking at ROI, the division manager may reject the new project. Because as we discussed earlier, based on averaging, if my current ROI is 20% and I take on a new project that's ROI is 14%, my total current ROI will decrease because of averaging, because my new project is below the existing 20%. So while this helps the division managers to maintain a higher ROI, it may hurt the company overall because the expected project ROI of 14% is above the minimum acceptable rate of return of 10%. And also, I would add to that by saying, over time, I would expect that this new project that the company is looking to take on, that the ROI over time would increase because the new project, of course, has greater potential of generating additional revenue for the company. So in contrast, if the manager of the Northern Division is evaluated using residual income, the new project would probably be accepted. Because as you know, with the residual income, since the 14% is above the 10%, that would mean the 4% residual income for each product produced. That would entice manager to make a favorable decision in going with the project. This is because investing in the new project will increase the Northern Division's residual income overall. In this way, the residual income supports both the divisional and overall company objectives. So let's look at this from an example. A wholesale division of Planters Peanuts Company has income of operations of $87,000. So income from operations are $87,000 for this company, and the assets for the company are $240,000. This is for the wholesale division. The minimum acceptable rate of return on the assets is 12%. What would be the residual income for the division? What do you think? This is your time to shine, class. What do you all think about this? What would be the residual income based off of this data? I know you guys know this. Devon says 58,200. Let's see, that's correct. And how we got there? The income from operations we said were 87,000. The minimum acceptable income from operations as a percentage, as an amount based off of the percentage, was 28,800. We got the 28,800 by taking the assets of 240,000 and multiplying that by the minimum acceptable rate of return on assets of 12%. And the residual income, as you know, is the income from operations, 87,000, minus the minimum acceptable income from operations of 28,800 to get the residual income of 58,200. Very well done, Devon. Very well done. Great. Any questions so far? Everyone's good? Again, you're all on mute, so if you have questions, unmute yourselves. Okay, great. Thank you, Monique. Appreciate that. Okay, so let's look at the Balanced Scorecard. The Balanced Scorecard is used by most companies, and I personally like looking at the Balanced Scorecard when I'm making a personal investment decision into a company. With the Balanced Scorecard, we look at multiple performance measures of a company. And this information is very helpful when I make an investment decision because it includes information that is not just relying on finance. So in addition to financial performance, a Balanced Scorecard normally includes things like customer service, innovation and learning, also known as R&D, and training, and internal processes of a company. So this is kind of how a Balanced Scorecard looks. We take into consideration customer service, R&D with training, internal processes, and of course financial performance. I look at all of these elements as a whole when I'm making an investment decision into a company, because this helps me to get a really holistic look into a company before making an investment decision. So the Balanced Scorecard attempts to identify underlying non-financial drivers or causes of financial performance as they're related to R&D and training, customer service, and internal processes. In this way, the financial performance may be improved. Because if you think about a company like Starbucks, The reason why Starbucks does so well is not because they have a great product. Of course, they do have a good product, as we know. But in addition, they have wonderful customer service. They treat their customers very well. And it's just like when you go out to a restaurant or you go out to your favorite clothing store or to another retailer. You like going there because they make you feel good. The customer service is really good, right? And so because the customer service is so good at these places, it makes us want to go back there. It makes us feel more comfortable in spending more money, right, while we're there. And so because the customer service is so good, it makes me want to spend more money with them, and thus improving their overall financial performance. And so looking at the balanced scorecard helps me to make an investment decision based off of this type of information. So looking at it holistically, with innovation and learning, also known as R&D and training, we have things like number of new products come out from R&D, new patents. From training, we can cross-train employees, number of training hours for employees, ethics violations for employees, employee turnover. These are all elements that we can look at when we're looking at a balanced scorecard. For customer service, we're looking at things like the number of repeat customers, brand recognition, delivery time to customers, customer satisfaction, the number of sales returns, and customer complaints. All of these factors help me determine how well my customer service is performing. For internal processes, we can be looking at things like waste and scrap from a manufacturing perspective, the amount of time it takes to manufacture products, the number of defects. We talked about Nike as an example of using Six Sigma in a previous chapter. The number of rejected sales orders, the number of stockouts, how often they're out of stock on things, and the labor utilization, how well they're using their employees. Those are all factors I look at for internal processes. And of course, on the financial side of things, I look at things like sales, income from operations, return on investment, profit margin, investment turnover, residual income, and actual versus budgeted costs, as we looked at in previous chapters as well. Now let's look at things like transfer pricing. This is when, in a division, the customer moves. Okay, so let's look at this from a perspective of Comcast, the cable company. So let's say you live in DC and you have Comcast and you're going to move to Maryland, where Comcast also exists. Well, internally, the company will transfer the service with the customer to their new residence. But of course, when we transfer that, there's cost and there's price associated with that transfer process. So when divisions transfer products or render services to each other, a transfer price is used to charge the products or services. So in DC, the Comcast of DC will transfer, they'll charge Maryland the difference for transferring that product or service to the Comcast in Maryland. Because as you would expect, there are different prices in different jurisdictions. Because transfer prices will affect a division's financial performance, setting a transfer price is a sensitive matter for managers in both the selling and buying divisions. So oftentimes what we'll see is they'll use different approaches to setting transfer prices, like market pricing, negotiated pricing, and cost approach. And market pricing, as you might think, different markets set different prices. So the service that you get with Comcast in DC will probably be different than the prices that you would get in Maryland. and also, of course, different from the prices you would get in Virginia. And so that's the market price approach. There's different pricing in those respective markets. Then there's the negotiated price approach. This is where, when you're moving from DC to Maryland, the two managers in the two divisions will negotiate the prices for that move. And so therefore, Comcast might tell you, the customers say, hey, you know what, you could keep your existing price instead of being going up based on the different market pricing. We call that a negotiated price approach, where the two divisions negotiate the price. Then, of course, you have the cost approach. That is where because the costs are different in the respective divisions, that the cost would follow that movement and transfer. So let's look at it from a little bit further. The objective of setting price transfers in markets is to motivate managers to behave in a manner of which will increase the overall company's income. Transfer prices will be set as low as a variable cost per unit and as high as the market price. Often transfer prices are negotiated at some point between the two. This is a terrible representational, so let's skip that slide. It's really bad. Okay, so let's look at it from this company's perspective. This company has the Eastern Division. This company has the Eastern Division and the Western Division. Now, in this example, the company does a lot of the actual manufacturing in only the Eastern Division. And in the Western Division actually outsources, meaning they purchase their inventory from another company entirely and sells it to their customers. So again, the Eastern Division in this example manufactures the product. The Western Division actually purchases the product from a third party and then sells it to the customers, which is why you see a price difference. Okay, so in the Eastern Division, their total revenue was $1 million. They had sold 50,000 units at $20 per unit. In the Western Division, they sold 20,000 units at $40 per unit, giving them $800,000. For the expenses, variable expenses for the Eastern Division were $500,000 because they sold the 50,000 units. The variable expense per unit is $10 per unit, giving them $500,000. In the Western Division, they sold the 20,000 units at $30 per unit. The reason why $30 per unit for the Western Division is, again, they're outsourcing by purchasing their product from the outside and selling it to their customers. So $20 represent the material cost purchased from the units purchased from the outside, and the additional remaining $10 per unit represents the variable cost of conversion expenses. We learned a little bit about conversion expenses in previous chapters, right? When we talked about converting raw materials to work in process to finished goods. So very similar. Then, of course, each division has their fixed expenses, and so forth and so on. So let's look at this a little bit further. So that was transfer pricing. Let's look at the market price approach and transfer pricing. Using the market price approach, the transfer price is the price at which the product or services transferred can be sold to outside buyers. In an outside market exists for the product or service transferred, the current market price may be the proper transfer price. In other words, depending on what the market is doing, I can transfer the product or service to another division within the company at the respective market price. This is true among companies that are in commodities like coffee beans, oil, other type of commodities, corn, soybeans, etc. Oftentimes they'll use the market price approach when they're doing transfers within the company. And it's fair to say that they want it to be comparable to what it would be to an outside buyer. So they assume that materials used by so let's look at this example. Let's assume that materials used by Wilson in producing snack food in the Western Division is currently purchased from an outside supplier at $20 per unit. The same materials are produced by the Eastern Division. In the Eastern Division, operating at 100% capacity of 50,000 units, and can sell its products to either the Western Division or to outside buyers. So in this example, the Western Division is just buying its inventory from an outside supplier at $20 per unit. In the Eastern Division, they are manufacturing 50,000 units at 100% capacity. And the Eastern Division has the opportunity to either transfer its inventory by sale to the Western Division, or it can just sell it to customers. A transfer price of $20 per unit, which is the market price, has no effect on the Eastern Division's income or company or the total company income. And the reason being is because the Eastern Division is already buying in the inventory at $20 per unit. So the Eastern Division will earn revenue of $20 per unit on all of its production and sales, regardless of who buys the product. And the Western Division would pay the $20 per unit for the materials at the market price. So in this situation, the use of market price is the transfer price. If there's unused or excess capacity in supplying the Eastern Division at the transfer price, it's equal to the market price. So the total company profit may not be maximized. That's to say that the manager of the Western Division will be indifferent toward purchasing materials from the Eastern Division or from outside suppliers. Because again, if the price is the same regardless of whether they purchase it from an outside supplier or it's transferred in at that same price, it's really not going to make any difference in terms of revenue for that respective division, for the Eastern Division. However, if the Western Division purchases its materials from the Eastern Division at the difference between the market price of $20 and the cost of $10, then the fixed costs can be attributable over the company's profits, and thus the Western Division should be encouraged to purchase the price from the Eastern Division. So here's how negotiated pricing works. The negotiated price approach allows for managers to negotiate among themselves in the transfer price. So in our example, if the Western Division and Eastern Division managers get together, they can agree upon a negotiated price to transfer the product between the two divisions. And so this would occur if the variable cost per unit is less than the transfer price, and the transfer price is less than the market price. In this case, the managers would use the negotiated price approach. The only constraint is that transfer prices may be less than the market price and greater than the supplying division's cost per unit. So in this example, let's assume that instead the capacity of the Eastern let's instead of 50,000 units, let's say the Eastern Division at 100% can manufacture 70,000 units. In addition, let's assume that the Eastern Division can only continue to sell 50,000 units. That's a difference of 20,000 units. A transfer price less than $20 would encourage the Western Division to purchase from the Eastern Division. So let's say that the Western Division can purchase at the variable cost per unit from the Eastern Division, which is $10 per unit. So here's how that would work. As you know, the Eastern Division is the one that manufactures. The Western Division, the one that sells from outside. So if the Eastern Division can only sell 50,000 units at $20 per unit, they would generate a revenue of $1 million. The Eastern Division could sell that additional 20,000 units to the Western Division at a negotiated price of $15 per unit. So the Eastern Division would still earn the revenue of $300,000. And the Western Division would be able to sell the 20,000 units at $40 per unit at $800,000. So here's where the difference comes into play, is within the variable expenses. The Eastern Division manufactured all of the products, 70,000 units in total. Again, they only sold 50,000 units to the customers, but they transferred or sold 20,000 units to the Western Division. So the total manufacturing for all 70,000 units at $10 per unit was $700,000. The variable expense for the 20,000 units that the Western Division purchased from the Eastern Division was $25 per unit. How we got $25 per unit is we took sorry, let me go back. We took $15 per unit, which was the transfer price, plus the $10 per unit it took to manufacture each unit, gives us the $25 per unit for the Western Division. Does everyone kind of understand this concept of transfer pricing? Does it make sense? Yes.
Yes.
Wonderful. Thank you. So looking at this concept from a negotiated price approach, any negotiated price transfer between $10 and $20 would be acceptable. The reason being is because the variable cost per unit is $10, which is the minimum. And the market price at $20 would be the maximum. So anywhere in between there would be acceptable. In this case, from the example, was $15. So as shown, negotiated price approach provides each division manager with an incentive to negotiate the price of materials. At the same time, the overall company's income from operations will also increase. However, the negotiated price will only apply when the supplying divisions have excess capacity. So in other words, looking at our examples, because the Western Division, the Eastern Division was able to manufacture 70,000 units and only sold 50,000 units to their customers, they had that additional 20,000 units to be able to transfer to the other division. And so therefore they were able to use negotiated pricing. So here's another example. The materials used by the Winston-Salem division of Fox Company are currently purchased from outside suppliers at $30 per unit. These same materials are produced by their Flagstaff division. The Flagstaff division can produce the materials needed by the Winston-Salem division at a variable cost of $15 per unit. The division is currently producing 70,000 units and has a capacity of 100,000 units. The two divisions have recently negotiated a transfer price of $22 per unit for 30,000 units. By how much will each division's income increase as a result of this transfer? What do you think? Any guesses? Devon says 210,000. Let's see, Devon. That's correct, 210,000. Now, the way Devon got there is we recognized that they agreed upon a transfer price of $22 per unit. The variable cost per unit is $15. So you take your transfer price minus your variable cost per unit, and we multiply that amount by the amount of units that are available to be transferred, so 30,000 units. We figured out that it's 30,000 units because the capacity is 100,000 units, and the division is currently producing 70,000 units. So therefore, the Winston-Salem division has the ability to produce an additional 30,000 units. So we would take the transfer price minus the variable cost per unit and multiply that by the number of units that are available for transfer to get 210,000. Very well done, Devon. You're on a roll. And of course, in the other division, in the Winston-Salem, we take the market price minus the transfer price times the number of units that were transferred to get the income from operations at 240,000. This is a good example. It's very well detailed. And just a small hint, I believe you may see this on the homework. So these slides will be very, very helpful for the homework assignment. So that was negotiated transfer. Now let's look at the cost price approach for transferring. Under the cost price approach, cost is used to set the transfer pricing. A variety of costs may be used in this approach, which include the total product cost per unit. As you recall from previous chapters, the total product cost per unit includes direct material, direct labor, and factory overhead. These would be included in the price per unit and the transfer price per unit. Variable cost per unit can also be used. If the variable cost per unit is used, the fixed factory overhead cost is excluded from the transfer price. Actual costs or standard costs that are budgeted may be used in applying the cost price approach. If the actual costs are used, inefficiencies in the purchasing supplying division are transferred to the purchasing division. In other words, if there's a difference between the cost and the actual cost and the budget, and that difference would be applied to the seller. So thus, there are little incentives to producing and supplying division to the control costs. And companies use standard costs, the cost price approach. In this way, the differences between the actual and the standard, or the actual and the budget, remain with the producing or the supplying division. Interesting concept. The cost price approach is most often used when the responsibility centers are organized as cost centers. And that, my friends, is the end of chapter 23. And look at that, we're done an hour early. So, are there any comments, questions or concerns with the information that we just covered in Chapter 23?
Don't have any questions.
No questions? Wonderful. Again, you're on mute, so if you have a question, please unmute yourselves.
I don't have any questions. You just have to make sure you know these formulas, you know, which ones to use.
Absolutely correct. As long as you know the formulas, you'll be all right.
Mm-hmm.
Great. Okay, so I'm going to go ahead and stop the recording now.